Good afternoon, everyone, and welcome. Thank you for joining today's KLG webinar, Cross-Examining a Business Valuator in Divorce Cases. My name is Samantha Brennan, and I'll be moderating today's session on behalf of the KLG team. Before we dive in, a quick housekeeping note. Today's webinar will run for approximately 1 hour with time reserved at the end for Q&A. Feel free to submit your questions in the Q&A box at any point during the presentation, and we'll do our best to address as many possible questions as we can before we wrap. Please note that this session is being recorded and will be available for playback shortly after we conclude. The presentation slides will also be distributed via email along with the playback link following this session. I'm just going to go through our disclaimer quickly. The information and materials presented today are intended for educational and informational purposes only. They are not intended to be construed or relied upon as specific legal, accounting, tax, or financial planning advice. And with that, I will turn it over to the experts to begin today's discussion.
Thank you, Sammy. Hi, David the Grim Reaper Groundlick. Today we're going to be talking about, expert. Basically, it's going to be about cross-examination of an expert. We're going to throw in some tips about working directly with your own expert as well. So first, we're going to talk about the role and importance of business valuations. Key methods, include the income market and asset-based approach, but really we want to talk that you guys should be well aware of Revenue Rulings 5960 and also SSVS 1. Revenue Ruling 5960 has 8 different points in it that each and every expert's report should talk about. If they haven't talked about or haven't at least cited 5960, that would be a very good place to start your expert witness questions. Along with, you guys should also be aware of and know SSVS 1, because it talks and gives a lot of different definitions on things like what the different approaches are, what discounts are, and all of that interesting information that's vitally important to knowing. There's actually a definition section in there as well. So why is this stuff important? Because, understanding valuation aids for all lawyers helps you guys in cross-examining us for accuracy. You should also utilize your own expert to not only prepare direct testimony, but to assist in the preparation of cross-examination of the opposing expert if you have your own expert. Lou, you were just involved in a 9-day trial, so you could probably talk about, your role there and how it was and how you did that a little.
Yeah, absolutely. Other than preparing for my own direct, there was expert witness testimony on tracing analyses, not just bank statement tracings, but also cryptocurrency tracings. It was a very complex financial matter. So there were businesses that were being valued, and the preparation for that cross-examination was key. And it's really important for the lawyer who's asking the questions to fully understand the valuation that they are cross-examining, because a lot of times the most effective questions are not the scripted questions that we give you, but the questions that are sort of derived on the fly based on the responses that you're getting, right? So an example of that is if you ask, is it true that the company's revenue grew from 2021 to 2022? And the answer is yes. And because you did your homework, you know that that's not true. That's not the case. You'll be prepared for a follow-up question and point them to an exhibit in their report and say, well, you just testified that the revenue grew. Is that actually accurate? So, to David's point, it's very important to be prepared.
All right. Moving on.
I'll go back one, Sam. Oh, you're done, David?
Yep. Moving on.
All right. Okay. So I guess it goes without saying, but I'd like to just mention the reason why we are obviously dressed like this is in the spirit of Halloween for tomorrow. Just to kind of put that out there. I'm sure it's obvious, but just saying it. So anyway, this next section, we're going to talk about scrutinizing valuation methods and discounts that valuation experts use. So first, valuation methods. So the choice of valuation method that an expert chooses really is critically important because it directly influences the value assigned to a business, which in turn is ultimately going to affect asset division and spousal support. So one of the areas of questioning, that you should consider scrutinizing is whether the selected method is appropriate given the business's size, the industry it operates in, as well as the ownership structure of the business. So you've probably heard this before, but just a quick overview. There are three common approaches to valuing a business. There's the asset approach, which is going to be based on the net asset value, so the business's assets minus its liabilities. And this method is generally going to be used for asset-heavy businesses such as a real estate holding company. Income approach, which is going to be based on future earnings and cash flow. So this methodology is going to be very sensitive to certain assumptions about growth, expenses, discount rates, or even projections if they're going to be used. The market approach is going to compare the business you're valuing to similar businesses that have been sold. So this methodology is going to rely on the quality of comparable businesses. So when you think about the meaning of these three methodologies and and what they're used for, it really opens up a ton of cross-examination questions. So, some of the areas that you might want to consider, why is a particular method selected by an expert and utilized? So, for example, why did you use the income approach instead of the market approach? Why did you reject the other commonly accepted methods? And what was the rationale for rejecting them? Would a different method have yielded a significantly different value? Were there any limitations or assumptions that were considered in selecting the methodology that's being used? So with all these methods, there are a handful of assumptions that are made that can significantly affect the value. So you want to make sure that you challenge these assumptions, and consider that in your cross-examination questions. So, for example, if they use an income approach, what growth rate did they assume? And how does that compare to the company's historical performance or their future expected performance? What did they, do about normalizing earnings? Were there any personal expenses? And Joe's going to kind of go into this in a lot more detail. But were there any personal expenses that were added back? And what would the effect be on the income and ultimately, the value? If they're using company projections, have they compared prior years' projections to actual results to see whether the projections are even realistic or attainable? If they're using a market approach, how did the company that they're valuing compare to the companies in the data set? A lot of times we'll see that the geographic location of the companies that we're looking at isn't, remotely close to New York. So one of the areas you might want to question them on is, where are these companies located that you're comparing? Were the companies that you're comparing more or less profitable than the subject company, et cetera? So, a good expert is obviously going to have answers to all these assumptions they made, or you hope that they're going to have answers to these assumptions they made, but it's an area where you could trip them up. But it's a good idea to challenge them and also to consider hypothetical questions to show the judge how sensitive some of these assumptions can be and what the overall effect on value would be just by changing these assumptions slightly. In terms of discounts, specifically a discount for lack of marketability and a discount for lack of control. This is an area that can also be very contentious in a business valuation. So scrutinizing these is going to be important because they can dramatically reduce the value of a business interest. So it's not uncommon to see a discount for lack of marketability, ranging somewhere between maybe 5% to 15%. A discount for lack of control for minority interest, maybe somewhere between 10 and 20%. So these discounts can have a huge effect on the overall value of the spouse's interests. So some of the questions that you might want to consider, just because a spouse has less than a 50% interest, who really controls the business and makes all the decisions? If the spouse makes all the decisions of the business, a discount for lack of control may not really be appropriate. Ask for justification and support for the discounts used. what studies or data support the discounts that they're considering, and how old is that data? Sometimes that data could be, going back, tens, go back into the 80s or even into the 70s. So you want to consider the age of that data and whether it's still considered relevant. Challenge the relevance of discounts for a divorce matter. So, for example, if this discount typically used for divorce valuations, or is it more common for estate planning purposes? Is there an intent or likelihood to sell the business? So would a discount really even apply? Is the spouse going to maintain control of the business post-divorce? And if so, would a discount really apply? So you really want to challenge the expert on these, on inconsistencies. So you probably, have come across multiple reports from the same expert over the years. And you want to look at those reports and see what are the discounts that have been applied in similar cases and challenge them. If there's inconsistencies between prior reports that have been used and what they're doing, in the current report. And again, here with discounts, it's great to apply hypothetical calculations so the judge can see what the impact would be on the value of the business, if you either lower or, or raise the discount. All right, Sammy, you can go to the next slide. Lou.
All right. So we're going to talk a little bit about scrutinizing forecasts and growth rates within the valuation model by way of cross-examination. This is a really important area if you're cross-examining an expert that has used a forward-looking income approach valuation model, such as a discounted cash flow method. And that's because the financial projections and the assumptions in the financial projections, they're central to the business valuation. But because they're so central to the business valuation, they often serve as grounds for some good cross-examination. And by challenging those elements, you may be able to demonstrate that the valuation lacks objectivity, and ultimately, obviously, doesn't reflect the business's true value. Now, specifically in divorce cases, the projections could be influenced by one spouse's interests, and that can lead to bias or unrealistic forecasts. The cross-examination should be geared to expose any bias or over-optimism or call it pessimism, if you will. If the projections are provided by the titled spouse or even management of the titled spouse's company, the projection should still be tested for reasonableness. If the expert's report doesn't indicate any testing for reasonableness, doesn't indicate any due diligence that was done to vet the projections, that is most certainly a good area for cross-examination to expose that the business valuator simply took the projections at face value. They simply put them into the model and they didn't give it any other thought. Okay. And they shouldn't just put it into their valuation model just because the owner or management said so. The valuator should do industry benchmarking. They should compare the projections to historical performance to see if they make sense. The valuator should inquire about any major events around the valuation date, such as acquiring a new large customer. Maybe they're losing a large customer. Is there some sort of new legislation that's going to affect the business and affect the projections? Are there maybe tariffs that are going to impact the business and how that, company is going to be able to support its gross profit going forward? Things of that nature should be disclosed within the appraiser's report. So to the extent that the appraiser's report lacks any of that foundation, that is a good place to, start with your cross-examination just to start the questioning the appraiser's credibility, right? Ultimately, you want to get into the trier of facts head, cast a little bit of doubt, that they did their due diligence in preparing the valuation in a thorough manner. Now, sometimes there are no management projections. So us business valuators, we prepare our own projections for the company. And again, the goal of the cross-examination should be to expose any lack of objectivity or any bias. And it goes both ways, right? If the valuator is working for the non-titled spouse in a divorce setting or a dissenting shareholder in a shareholder dispute, you want to try to show that maybe the projections are overly optimistic, right? As an example, has the subject company historically underperformed industry, but now in the projections, the subject company is going to outperform the industry. If that's the case within the valuation model, there should be a clear rationale presented in the valuator's report. If there is not, therein lies your opportunity for cross-examination to show that there's no basis for what the valuator has done. Uh, Conversely, you can do the same thing if the valuator presents the titled spouse or, in a shareholder dispute, the continuing shareholder, if the projections are overly pessimistic. At the end of the day, whether you're arguing the projections and growth rates are too high or too low, the projections should be supported by independent analysis. They should be supported with industry growth rates, historical analysis, things of that nature. And if the expert report doesn't disclose that analysis, or if you get their work paper, which is commonplace, right? If you subpoena their work paper file and you get their, all of their underlying schedules and analysis, and you're not seeing anything, your cross-examination should uncover that exact point that maybe the projections are too speculative and they're unsupported. And perhaps they favor, whichever spouse they're representing, a little bit too much. Ultimately, when it comes to testifying to our business valuations, credibility is everything. So when you start to, get into, that credibility, then you definitely start to cast doubt in the trier of fact's mind. Sammy, you can go to the next slide. So I'm a big fan of demonstrative evidence. I think that it goes over well in sort of highlighting to the judge or the trier of fact. So I put together a quick chart, two quick charts, and I just want to show you this is a historical blue line, historical revenue that goes into projected revenue, right? And this is obviously just this was just created for this purpose. So I made it work pretty perfectly, right? That this company is just on this nice upward trajectory, and as it's growing, its growth rate sort of peters out. You can see at the bottom there, 30% all the way down to 5%, and it's this sort of smooth trajectory, okay? And the growth rates have this sort of smooth decline. Now, Sammy, go to the next slide. Okay, now let's say you're representing the titled spouse or business valuators testifying on behalf of his business valuation for the titled spouse, and you show this, right? And you show, well, the growth rates were, 30%, 28%, down to 20% as of the valuation date. And then all of a sudden, look at that giant dip in the growth rates going forward. So it's just a demonstrative that'll show, the trier of fact in an easy way. Their projections may be aggressive to the low side, or put another way, they may be too conservative, and that is because they're representing the titled spouse. So I just wanted to show you, just quickly a couple of ideas for demonstrative evidence that all it's taking is information from the report, and it's showing it in an organized way that gets the point across that you want to display. You can go to the next slide.
This is my section.
Ready?
So, in most valuations of closely held companies, especially valuing controlling interest in companies, an appraiser often makes adjustments to the company's financial statements. These are often referred to as normalization adjustments in our report and analysis. Now, of course, when you cross-examine the expert, the first thing to know is the expert the neutral expert, or is he working for the titled spouse or the non-property spouse? So, of course, that's going to control a lot of the tempo of the cross-examination. But let's work on the assumption that's the neutral appraiser that's on the witness stand and you're preparing for. So one of the first things you should look at is if did they make balance sheet adjustments, and is it fully explained in their report? Are they saying what adjustments they made? Are they giving credibility to those adjustments? Some can include most tax returns are prepared on a cash basis of accounting. So the question can be asked is, did they do it on the accrual basis? Did they include items such as accounts receivable? And if they did, is it net of taxes? Or, maybe you're the representing the property spouse and the appraiser just took the accounts receivable, and in their report they don't make any mention if they made any significant adjustments for collectability or bad debts. Maybe that would be the questions. You would ask the appraiser, did you speak to the owner and discuss with them the viability of these receivables? Are they all collectible? Is there an aging report you reviewed as of the valuation date? So again, did the appraiser do all the necessary things to, put that adjustment on the balance sheet? Same thing with maybe fixed assets. The inquiries can be made. Is there, true business assets on that balance sheet, or did they make adjustments for any accelerated depreciation? So, not to get into accounting, when you're reporting fixed assets of a business, you're putting them on the cost basis and you're taking depreciation. But in some businesses, they might take accelerated depreciation, Section 179. So it's going to be reflective on the balance sheet. Those assets might be at a much lower cost basis than if straight line depreciation. So those questions can be asked. Also, is there any non-operating or non-business assets, vehicles, the children's cars, but also any real property that might be on there that might need to be an appraisal. And then if there is real property, did the experts consider, the market value of those assets in their analysis? Another area to attack or to look at would be shareholder loans on the balance sheet. This can be either as a receivable or a payable. So, if they borrowed money from the company, it's a receivable. The questions can be made as, well, how far back is that transaction go? What was the purpose of that? Why did they borrow money from the company? And will it be repaid? Same thing with the liability. Did the company borrow from the shareholders? And again, will it be repaid, and what was the purpose of those loans? So a lot of questions can be made on that. So if the appraiser didn't make the adjustment, why didn't they make the adjustment to equity, or if they left it on the books? So you just want to check the legitimacy of those type transactions. As I said, there could be items like marketable securities on a balance sheet. You need to look to see, did the appraiser consider the market value of those? If it's stocks, did they get a brokerage account as of the valuation date? Did they make that adjustment? So that should also be considered. And looking at debts, the liabilities, again, is there a business purpose to those debts? They have, especially with COVID, there was still, SBA loans that were taken. Did they use those funds for the intended purpose, or did they use it to buy a boat or a house? And then it's still on the liability of the company when it really should maybe be personal debt at this point. So these are just questions and areas to look at. And the appraisals and often in the report should have a whole narrative on these adjustments. But again, it's a treasure trove of questions that could be asked, which would lead us now to maybe the income adjustments, which is definitely the area of usually most contention and examination that could be done, especially, when there's battling experts. Some of the differences could lie in the adjustments to the income that are being made. Again, we all start with basis information, tax returns, financial statements. But then from there, we want to clean up the books if necessary to make sure we're accounting for personal transactions, perks, non-recurrent business expenses, any off-book income or expenses that might need to be adjusted for, reasonable compensation, capital expenditure allowances, or working capital needs. So again, what should first be examined, did the appraiser put in, the basis for all of their adjustments? Is there validity to their adjustments? So if they're adding back personal expenses and they just said, well, I took the appraiser took 100% of the credit card charges. Questions that could be asked is, well, did you do a specific analysis? Did you just add back 100%? Was there any inquiries made? If you're the neutral, did both sides get to look at the credit card statements and make their representations as to what's personal, what's business? Does the accountant do any allocations? And if none of this is, what independent analysis did you prepare as the appraiser? Did you do specific identification adjustments where you added certain specific items, or did you do estimates or ratios of what you believe personal items? So this again could be a very, you know, treasure trove of cross-examination question where you can keep the witness stand expert on the stand challenging their analysis, because again, maybe expert one has $100,000 of adjustments and your consulting expert says, no, it's really only 20,000. And it's just bridging that gap as who's more credible in their analysis. So, focusing on that. Um, Same thing with reasonable compensation, challenging sources. Again, is this, you know, fully presented in the report? Is it explained where the sources of that information come from? What was the basis of that adjustment? Oftentimes when we speak with business owners, they might say, well, I work 80 hours a week, and I'm the chief bottle washer to the CEO of the company. I do it all. I wear many hats. I guess the question is going to become is, well, did the appraiser consider all those different types of services in determining their reasonable compensation, the past full-time equivalent of that adjustment? How many people would be needed to replace that person? So there's a lot of questions that could be asked, of the expert, specifically with reasonable compensation. And we as, internally, we constantly always make sure we prepared and our files are clean on that we have the relative information, because we're always assuming, as Glenn Liebman always says, it's a bingo ball of what cases might go to trial. And, every case we got a view that's going to go to trial and we're going to be challenged on it. And we make sure that we have all our, our supporting evidence and, that we can back up any number we put in the report. So that's why we're always preparing for these type of cross-examination topics or questions that might come up. So that's really basically in a nutshell areas where I think the cross-examinations can really focus on. Again, it's checking the validity of expenses, what sources of information that were relied upon, what analysis did the experts do, and was it fully conveyed in the report? Because if not, then this is your chance as, to challenge the credibility of those adjustments on the witness stand.
So we have a question, Lou, that you want to handle because it's over your subject line.
Sure. So the question is, can you say when you would use the DCF, which is discounted cash flow method, versus capitalization of earnings, or are they both used in the same business valuation? So to first answer the first part of that, or the second part of that rather, is no, you wouldn't use both the discounted cash flow method and the capitalization of earnings method at the same time, because they are specifically reserved for very different purposes, right? Very different types of companies. Now, you're going to use a discounted cash flow method when you're valuing a company that is experiencing either fluctuating cash flows or extreme growth rates, right? A company that's growing at 30% per year, 20% per year. And what you do in the discounted cash flow method is you prepare that projection over the course of period of time until which that company has reached stability. And then it goes into what's called a terminal calculation. And that's an entirely separate webinar that we can give. But essentially, you're going to use a discounted cash flow method when the company is either experiencing rapid growth or has some fluctuating cash flows. A capitalization of earnings method is used when the company has already achieved stability and they are just going to have their 2 or 3% year over year growth that's based on the economy and GDP growth, and is essentially just a stable company. So discounted cash flow method, future looking model, growing companies. The capitalization of cash flow method looks at historically what the company has done and just estimates going forward a stable amount of cash flow that you'll run through the model.
And just to add to that, I mean, a big question is going to be whether projections are available. We don't want to. We can assist in preparing projections, but we don't want to, especially in a litigation type case, we don't want to be the one preparing the projections. We don't know the company like management knows the company. So, if the company regularly prepares projections going into the future, and there's a history of that, and we could compare the projections to actual results to see if they've ever attained those projected numbers, we're going to give more credibility to that than if, they just throw something together and, it's the first year that they're doing it. There's no history of them attaining those results, etc.
So just to go back, Jeff talked about the three different methods. I remember I was once on a case where I used the market approach, and what I did is essentially the other side used the market approach, and I went in and I picked out certain transactions that really undermined what they said. They were totally different than what their conclusions were. So that's one reason why you might want to be really work closely with your own expert, because they can get that data for you, and really help you with your cross-examination questions. So I think that's an important place that you can really work with your expert, and that would assist you with your own expert and cross-examination questions.
Yep.
Yeah, and I would just add, direct too. I mean, if we're working for an attorney, we're not neutral in a case, I'll always ask to do my own direct, because the most painful thing is when the attorney is asking questions and their own expert is not in sync with what they're asking, and it looks like they've never practiced this before. So I'll always ask, can I prepare my own direct? And if not, at least let's go through it so that I'm aware of what you're going to be asking. Because I've seen it a couple of times and it's just painful, watching a direct where, it looks like the attorney and their expert have never spoken before.
Tammy, can you go back a slide?
Yeah.
Sure.
Thank you.
So other areas of key cross-examination that we touch upon is oftentimes is, and if you are dealing with experts, and we kind of deal with the same few sources, there's a few experts that dabble in certain areas, like in litigation, matrimonial, we come across the same experts. So the attorneys and the judges do know the credibility and qualifications, but so oftentimes if there's other type cases and something, maybe it's a high level, they're bringing in economists or other valuation experts. One area is really to challenge them on is their qualifications. I mean, how often are they valuing businesses of the same nature of the subject interests? How many have been done for the purpose of the case, whether it was for matrimonial or for a shareholder dispute, their testifying experience, of course, and just going through their CV and LinkedIn, because oftentimes, and we have examples of this, which we won't put on the people on the bus. They might have elaborated on their or embellished their CV a little bit as to their experience, and we can poke holes in that, or even something as silly as they didn't, they're not fully active CPAs and they let their licensing lapse. But we can do the searches, but that's also again looking at the different credibilities of the expert. I mean, they're putting forth their CVs. It is information, whether it's on their websites, LinkedIn, or the attachments to the report, walking through some of those, qualification issues.
I would also add, with regard to the valuators' qualifications and their credentials, it doesn't just speak to the credibility of the witness, but it also may speak to the weight that the trier of fact ultimately is going to give to that valuator's opinion. So it's important to vet that valuators' credentials and their experience and things of that nature, and if necessary, highlight that more weight should be given to your own expert than to this expert, just based on credential and experience alone.
Also, in things to consider is looking at, again, maybe flaws in the methodology that we're choosing. Sometimes in specific industries, one method might be the preferred method. And if, just by doing searches or through AI now these days, you do in a certain industry, they might say the income approach is the preferred method and value in XYZ company. And the appraiser in this case, or the expert, used a completely different method and they ignored that method. Now you have a litany of questions you could ask as to why, and then, something to show them saying, well, the industry or case law or whatever this is says this is the methodology to choose, and you deviated from that. Why? Again, we touched upon some of the underlying assumptions, whether it was growth rates, the projections, but again, these reveal, speculative or biased assumptions the appraiser might have. Is it, some parts, is again the old argument is valuation an art or a science? We try to do things as, as supportable, on a scientific basis, but there is those, subjective areas where assumptions should be made, but again, are they valid adjustments? Are they valued speculation or subjective parts? Again, whether it's in the cap rate or the reasonable comp. So again, looking at those areas and finding the underbelly of the weakness, and also again, maybe use another expert to help you and guide with these questions. Again, this is all work. This is what we do. So reading a report is second nature to us, and we can find these, you know, deviations or areas to attack with relative ease, and we can help assist and write into questions and to maybe prove that point. So again, often utilizing experts in your cross-examine to challenge other experts is valid advice. Do you have a question someone might want to address?
Yeah, so there was a question, if a valuation contains two potential values based on conflicting positions on income or expense, what advice can you give to counsel on cross-examination to move the trier of fact to pick one value over the other? So generally, when you see a situation like that where there's two values, it's usually because there's conflicting information from the parties. And so we'll generally say, listen, we're not the trier of fact. If one party tells us one thing in terms of personal expenses being paid through a business and the other party tells us, something different regarding, the volume of personal expenses that are being paid through a business, we're going to prepare two different scenarios because we don't know who's telling us the truth unless it's obvious in the documentation. So I would say, different scenarios obviously will different hypothetical situations. If this value, if we were to consider this as a personal expense, what would the effect be on value? If we were not to consider this, what would be the effect on value? I think that's a good way to kind of demonstrate to the trier of fact what the overall effect is on value. But I think ultimately, who's telling the truth has to come out through either cross-examination questions of the witness or through the deposition questions. Because we're not going to know, unless there's documentation that's leading us one way or the other, we're not going to know who's being forthright with that information. And we see that a lot.
I would also add to that, specifically on cross-examination of the expert. Let's say you have two different scenarios of add backs, right? So, using the husband and the wife as an example in a divorce case, and the husband says that there's $50,000 of perks, and the wife says that there's $200,000 of perks. Obviously, the husband owns the business in this scenario. A good cross-examination question could be, after considering those add backs, did you do any analysis to determine whether one scenario was more reasonable than the other scenario? So let's say just doing $50,000 of add backs on the husband scenario generates a profit margin of 15% for the business, right? 15% of revenue. But industry guidelines say that this business should be pulling down 25% to the bottom line, and that's more in line with the $200,000 that the wife came up with. As long as you're prepared, as long as you prepared with your expert with that industry information to come into the cross with, that's a really good way to sway the trier fact to see, okay, well, they did two scenarios because they had varying opinions of personal expenses, but based on the wife's add backs, seems like the resulting profit margin is in line with industry, and that should resonate with the trier of fact. So that's how I would approach that.
And also maybe reviewing the party's net worth statements as to what their annual lifestyle is another, sanity check we do, besides looking at industry ratios is, if the party's lifestyle is $300,000 a year, but then again, reported income is 50 and with adjustments, now it's up to $200,000. There's still a shortfall. So unless there's some sort of representation that there's other sources of income, maybe they would tend to lead to credibility of like an Lou's example the wife's adjustments might have more validity because now it's going to tie into the economic reality of how they lived and their income that they lived on. If this was the only source from the business. So again, the experts should check that. But again, that's part of cross-examination question because if we're working or helping you consult with that, and that's an issue, that's a glaring issue, we will point to their, the party's own net worth statements and say, well, how did you deviate from that? What are the other sources? So there's always a lot of things that we consider, especially with the adjustments as to the reasonableness. We're nothing, before we even conclude, that's an area we put heavy focus on because we know it's the most challenged area besides methodology.
I just wanted to go back to the last bullet point on this slide that we're looking at here. Contrast with your expert. I think it's really important to keep in mind this specifically in a case when you have your own expert and the other side has their own expert. This isn't really for when you're cross-examining a neutral. But when you're cross-examining the expert on the other side, it's all about credibility, right? But it's not just about questioning the credibility of the other expert, but it's also to bolster the credibility of your own expert. So there's a lot of time, a good opportunity in cross-examination to support or strengthen the report and the conclusions of your own expert. So a good example of that is if you're doing a valuation of I don't know, a restaurant, right? And you know that your expert reviewed POS system reports and the other expert did not. On cross-examination, you can ask, you did not review POS reports in preparing your valuation, correct? Leading question, yes or no? No, I did not. Uh, but Mr. Gibraltar, he did review POS reports in preparing his valuation, right? So right there, whether or not the valuation reports are relevant to the valuation anyway, you've already put in the trier of facts mind that your own expert did another layer of analysis beyond what the other expert did. So, those are always points that we try to highlight on cross of the other side to help support our own assumptions and analysis in our report.
Excellent point.
Yeah.
Good point, Lou.
Thank you. Is there anything else?
Any additional questions?
Okay.
All right. Well, again, I think the overriding theme here is just the first thing you need to really understand the report before you can go out and cross-examine any expert, really. And you have to understand our treatises and our rules behind that before you can really go further. And then very oftentimes it's going to help you to utilize your expert if you have one in order to assist you with cross-examining, because there are certain treatises or information that we're going to be able to ascertain that you may not have access to. So I think that's a very important point. And again, you want to bolster, as Lou said, your own expert, and the other expert you want to show some doubt in the judge/jury's mind with regard to this. So if there's no questions, hopefully you guys enjoyed the presentation. And if you're music fans, as Blue Oyster Cult said, don't fear the Reaper.
Please, Sammy, you could go over to the next slide. I think we have our general no, maybe not. Go one more.
Next page.
There you go. So here's our contact information. We have our general email inbox here. If you ever have any questions specific to cross-examination or anything else, always feel free to email any of us.
Or if you have a report from another expert and you want to just, see whether it makes sense, we're always happy to take a look and see, if it's an opportunity to do a rebuttal report, or, if essentially we would, come in with relatively the same value as what the other expert did. We're always happy to take a look at that and help you where we can.